At the beginning of this module on technical analysis, I explained that traders use technical analysis on their screens to try and determine which way the price is going to move and trade it accordingly. So on the screen at the moment we can see a Euro US dollar daily chart, and the price is shown by this panel on the left hand side. So we can see the price is fluctuating around 117.64. We would press the box on the left hand side to sell it, or the box on the right hand side to buy this particular pair. If we wanted to put an order in to trade above or below, we would use this depth of market box, which I mentioned in the article as well. So the mid-range is here. So if we wanted to buy above this particular line, we would just simply come up here and choose one of the levels and press on the right hand side to buy, or the left hand side if we wanted to sell the market above the current level. And we can also do that below the current level. We can put an order on to buy it below the market price, or to sell it below the market price. So on this particular screen we can see a line chart, which I mentioned. Some traders like to use a line chart, and all it does is the price fluctuates up and down on the screen, and it leaves this line on the actual chart, and traders look at that. For example, they might see that the market is topping out, is failing to go any higher at these levels. It's certainly fading by around about this level here, and presumably they might think that the market is fading and might start to reverse. That's exactly what happens, and we can see this trend to the downside. So we can see the current price on this black box here. It's showing the current price. There's a line that goes right away across the horizontal line that goes all the way across our chart at the moment, and some traders will look at that and think, okay, well, this was the bottom of the market here, so I might expect that the market might bottom out on this side of the screen. So they will look for tops and bottoms, and that's just one of the particular ways that they trade the market with a line chart. They also like to use bar charts. So these bars are straight lines, and they will open for a set period, and as I mentioned, this is a daily chart, so each one of these vertical lines is denoting a day. So we can see that the market is rising on a blue bar chart, and it's falling on the red one. We can just about see that there is a little line coming out on the left hand side and the right hand side. That shows where the market opened. Price moves up, falls back slightly, and closes by the line on the right hand side there. On this particular bar here we can see that it's red. So the market opened on the level on the left hand side, it went up, it came down, it ended up closing almost identical to where it opened, and that's just another tool that traders like to use to trade. They also use candlesticks. These are probably most popular. So in this case that they are more solid, and they will leave a wick. That's why they're called candles. So for example, on this particular candlestick here we can see very large wick to the upside, very large wick to the downside, and price opens on the solid segment on the left hand side and closes on the solid segment on the right hand side as well. So it's been up, it's come down, but overall that is a downward trending candlestick.